Hi guys, a good day to you all. So thank you so much for taking time to watch my video. So this is longer than we anticipated because of a very good interaction with the participants during the webinar. So which is why I summarized the topics on you guys. So if you click on the description, so you can see here the different outlines of certain topics. So if you wish to focus on a specific topic, you can just just forward the video and go there right away. So it's broken down per topic. It will be easier for those who have not really attended the webinar. I'll be creating more webinars, more recorded videos for you to learn about basic taxation and finance or anything of your topic. So in case there are certain topics here that you need more clarification, please feel free to email, call, or text me. My information is flashed on all throughout the video, and I promise you that whatever webinars I'm gonna be doing, it will be recorded, and so that you can review, you can watch it over and over again. So happy watching and start learning.
Good evening, everyone. Thank you so much for joining with us tonight. My name is Jinky Dalmar. I am a licensed real estate agent and also a financial advisor. I have been a realtor for 5 years. I'm with EXP Realty, and the purpose of this webinar is for us to learn and understand how taxes work in Canada and why it is important to have an effective tax planning. I have some clients who are asking questions to me about tax, and since I am not an expert, I don't want to pretend as an expert. That's why I invited our very valuable guest speaker for tonight. Okay. So without further ado, I would like to introduce to you our guest speaker. He is Mr. Clive Cabernet. He is a registered tax preparer and has been filing taxes for his clients for 18 years. And he also founded his own company, Tax Call Canada. I think it's very beneficial for us to learn and understand about tax planning and what the advantages of tax planning, right? Especially now that it is tax filing season. So without further ado, please welcome Mr. Clive Cabernet.
Hello, yes guys. So I'm very excited actually. This is actually my first webinar. I've been planning to do this last year, but since COVID happens, like I've been so busy with my family, vacation galore. So now at least we finally started it. And this is just the beginning though. Going forward, we'll be conducting more webinars, and probably I could invite Chinky as well to share with us on how we can have the chance to buy our own home, right? So that's basically my goal. I want to have my own home. Okay, so for those who doesn't know me, or those some of my clients who doesn't really know me, let me just quickly introduce myself. Yeah, so I'm Clive Cabernet. Okay, so I am the father of 5 kids, so kind of busy in my own home. And then I've been a tax advisor. A lot of people know me as tax advisor. I've been registered since 2005, so this will be my 18th. In 2000, I started with basically only 5 clients, and then just last year I got 1800, so not bad, right? It's actually growing. So we're servicing now to thousands of clients, and then aside from that, I'm also a licensed investment and insurance broker. Okay, I've been doing that since 2009, but I'm not more into the insurance, I'm more into the investment side of the industry. And then I also do online trading. So I've been trading stocks and currencies since 2016. And my previous career, I was a licensed public accountant back in the Philippines. Okay. And then when I moved here, I was a nanny. I was a caregiver for 3 years. And then I was able to transition from a caregiver to an accountant. So I was an accounting supervisor for 13 years. In 2019, when I finally quit, and I focused being an independent broker and also a tax advisor. Okay. So our topic for today is all about Canadian taxation on personal income. Okay, Canadian taxation itself is very broad. So this webinar is not intended to make you as an accountant. I don't even recommend that you do your own tax. Not because not because I want you to be my client forever, but simply because taxation is complex matters, right? So there are DIY or do-it-yourself software that we can use, we can buy, or online that we can avail for a cheaper price. But let's face it, taxation keeps changing every year. So there's only two scenarios if you DIY your own tax. Either you get more refund that you should be and you're gonna be audited later on, or you get lesser refund that you should be, and it either ways it's not on your advantage. So better have a professional do your own tax. It doesn't have to be me. Like for those who are not my clients, it doesn't have to be me, but as long as you have a trusted individual that will do your tax regularly. Okay. So this is our Canadian tax rate. Again, it starts with 15% for federal, and for Ontario, it's 5%. Alberta's actually higher because Alberta starts with 10%. So their lowest tax bracket there is 25%. Us, at least it starts with 20%. But the moment your income becomes above 46,000, your provincial tax is now become 9%. So your total tax bracket is 24. And that keeps increasing as your income increases. Okay, so for example, if you are on a 31% tax bracket, doesn't mean all your income will be 31%. No, any in excess of the 92,000 will be 31. Okay, for example, here in excess of the 50,000, it will be 29%. In excess of the 46,000, it will be 24%. Okay, so that's what we call progressive income tax. So that's why if we do income tax planning, the first thing we have to ask is how much is my tax bracket? Because for me, if I am already on a 38% tax bracket, for example, I'm a nurse and I'm earning more than I earn like between this range, 100,000 to 150,000. If I work overtime, is it worth for me to be taxed with 38% on my extra hours, right? I rather stay home and be with my family than earning more and then just be taxed almost 40% from it. Sometimes it's not really worth to work too much because you're burning out your body, but basically you're giving back more of your income to CRA. Okay. So how tax is being calculated? So what they do is they add all the income, and then on our income we also have taxable deductions. So that will be our net income. Okay, and then from our net income, that's the basis for calculating for federal tax, provincial tax, and then the non-refundable. No, we also have non-refundable tax credits, which is a direct deduction to our income tax. But the reason why it's called non-refundable, because if this is more than the tax, it doesn't generate a refund. It will just make your tax zero. Okay, we'll identify those later on, and then out from that will be your total tax payable. And then we will deduct from that whatever income tax you paid from your payroll. And then we also have what we call refundable tax credit. So refundable tax credit is basically what if there's more refundable tax credit than your own tax, then you get more refund. Okay, so that would be the basis. Either you get a refund or you have an owing. So let's identify all the taxable income. Okay, so these are our taxable income. First, employment. Okay, that's the most common, followed by employment insurance, and then net business income. Okay, not the gross income. So that would be your gross business income minus the expenses, and then pension income, rental income. So the rental income here is net of your rental deductions. Okay, not the income not the money that you got from your renters. And then any social assistance and RRSP income. Don't worry, we're gonna talk more about that RRSP because that's a very sensitive topic. A lot of people are getting RRSP, but they don't know the tax implication of it. And any other income like capital gains on your investments, WSB, or you're giving support payments to your ex-spouse. Okay, support payments, not child support, has to be spousal support. Child support is tax exempt and also not tax deductible. And any foreign income, like if you're working overseas or you're operating a business abroad. Okay, so whatever income you have here, that's the basis for when you apply for a loan, you apply for a mortgage. Okay, that's not a taxable income yet. That's just our total income. So if you're planning to buy a house and you want to maximize your income for you to qualify for a mortgage, then you have to maximize all these types of income. Okay, so if you have business, if you run a business, better not deduct much deductions yet, so that your net business income will be bigger. Then out from that, we have what we call taxable deductions. Okay, taxable deductions would be pension adjustments. Okay, if you're contributing to your pension or company's pension plan, and RRSP contributions. If you're buying RRSP, that's why this January, February is actually RRSP seasons. A lot of people are buying RRSPs because that would be deducted from your total income. And then when your total income is lower, then you got more refund. Union dues, childcare expenses, moving expenses, any employment expenses. So employment expenses most likely related to like PSWs who are driving from one place to the other to service clients. Okay. COVID, any COVID repayments, like if they ask you to repay back whatever CRB or CRB you received in the past 2 years, so it will be deducted also from your taxable income. So out from that, whatever the net, that would be the taxable net income. Okay. So let's talk about childcare expenses, because this is what most people are doing, especially if you have kids. Okay, again, childcare expense is a taxable deduction. It will be deducted directly from your income. So you cannot claim everything. So the maximum you can claim if your child is 6 years old and below is 8,000, and any above 6 years old is 5,000 only. But if your child has disability, then you can claim as maximum of 11,000. So childcare expenses are direct deduction from your income, lowering your taxable net income. So taxpayer must be earning an income, either employment or business. So if you have zero income, this may not have any impact on you. And then for a family, for a couple, normally the lower income spouse should make the claim. So for example, the husband is working and the wife is not, then the childcare expenses may not have any impact because the lower income spouse don't have any income. Well, with exception, if the lower income spouse is sick or at school, then the higher income spouse may claim. So the good thing about living in Ontario, because Ontario actually give us refundable tax credits. What do you mean by refundable tax credit? Even if you have zero income, as long as you're paying child care, right? Our premier, Doug Ford, actually give us extra money for that. So as your income increases, then the tax credit rate decreases. So it's still based on income. So let's take, for example, what if Jane Doe is 35 years old, single mother with 2-year-old daughter? She paid 12,000 in daycare. And the net income of Jane Doe is 35,000 annual. So the maximum allowed for that 2-year-old child is only 8,000. So the tax credit rate for 35,000 is 63%. So she would get additional refund. Okay, that's refundable. If she doesn't owe any tax, then she would get more refund of $5,000. But I think this is gonna change because gradually we are transitioning to the $10 per day what do I call that, child care subsidy, right? Or child care expense. So basically we pay only $10. So I think they're gonna change that. They're gonna remove that refundable tax credit. I started seeing that refundable tax credit like 4 years ago only, just a year before COVID. Okay. So when it comes to non-refundable tax credits, so again, non-refundable tax credit is when you have more credits, it doesn't give you a refund, it will just zero out your tax. Okay. So what are the non-refundable tax credits? So we have two credits, provincial, federal and provincial. So for federal, it's 15%. Okay, whatever tax credits you have, they will calculate, CRA will calculate 15% from that, and it will be deducted from your federal tax. So the first one is basic personal amount, which is 14,000 for federal and 11,000 for provincial. What do you mean by that? So meaning on our first 14,000, we're not actually taxed. Okay, so if I illustrate that basic personal credits is embedded in our regular payroll. So this is what this is the cause of why most people pay more tax when they have more jobs. Okay, because in our payroll system, the software already included our basic personal credits. For example, if you're paid bi-weekly, so every pay period, the first 500 of your income is not taxed. Okay, so for example, if your bi-weekly gross income is 2,000 and they will deduct $500 for that, so the 14,000 will be the basis for withholding tax. So in this example, the lowest tax bracket we have for federal is 15% and provincial is 5%. So in this example, the federal tax is $216 and Ontario tax is $73. So total tax deduction that you will see in your pay stub will be 289. Okay. But the problem though, the most problem is you have two employers at the same time. This is causing more problems to very hardworking Canadians, because both employers are now using two credits, right? Both credits on employer one, the first 500 is not being taxed. The second employer, the second income is not all it does. The second income, the first 500 is not also taxed. But actually, you only have 14,000 credit, not 28,000. So what it means is, after tax season, when you file your tax, the second employer, the second income is actually taxed less, right? So that's why if you are on that scenario, you have to inform your employer that on your second employer, you have to inform them that you have another employer making the credit. Like, you have to tell your what do you call that, HR department, that they should not use your basic credit. But most of the times, what they tell you though is they will tell you, how much tax do you want us to add on your payroll? If that's the case, just make a rough calculation of how much your total income is. So for example, your biweekly is 2,000, then use that right away for calculating your federal and Ontario credit. So tell them, on my federal, it should be $300. And in my Ontario, it should be $100 or $400 right away. Although it may look big, but with taxation, with CRA, either you pay tax in advance or you pay tax later. For me, I rather pay tax in advance so that I don't have to worry about it later. After all, if this is excessive enough, this will be refunded to you anyways, as if you're just making your own savings account. Okay. And the thing with CRA, if you don't owe any money, like you have a refund, you don't have a deadline, you don't need to chase everyone and file your tax by April 30 because you don't owe anything. Like me, I file my tax every October because I don't owe any money to CRA. So you can actually make your tax as your savings account. How you do that? You tell your employers, deduct $300 per pay period, deduct $400 per pay period. So actually, I even told some of my clients, if you're hiding money from your spouse, the tell your employer to deduct more taxes, so that your wife, your husband will see a lower net, but actually you will get more refund in the end. So either ways will work, right? That's why you can also voluntarily pay your own tax. For example, some employers doesn't let you do this. They don't want to take the hassle of taking more tax from your payroll. So you can pay your own tax in advance. So you can add a payee list on your online banking, and then just type CRA, and you will see there are a lot of options. Select CRA installment. So if you select CRA installment, whatever money you put there, that will be applied on your next year's tax return. For example, if you do it now, for example, every paycheck you put $100 there, that $100 will be applied on your 2023 income tax return when you file your tax next year. So in that way, you're banking more tax deduction, and you get more refund later on. Even if you file your tax late, you don't have to pay penalty. Okay, that's what I do. Every tax season, I pay like 5,000, 7,000 of my income in advance. And by next year, I would recoup portion of what I paid. Okay. So in this example, for example, if you work with two employers, on your second employer, supposedly your tax deduction on your pay stub should be $400. If it's less than that, that means you're short paying your taxes. You're gonna pay it later on. So it's still for me, even if I have thousands of dollars in my bank account, I would feel bad to take out 2,000, 3,000 from it just to pay for my own tax. But if I have it in advance and I would recoup it later on as a refund, that would be a positive reinforcement on me. Like, I feel good that I get a refund. Okay. So sometimes employer cannot do it because they don't have sophisticated payroll system. So instead, they will ask you to ask additional tax. So you just have to manually calculate your own tax based on your tax bracket. So the easiest way is 20%. Suppose that whatever gross income you have, at least 20% of that. Okay. Second, spousal credit. Spousal credit is same as basic credit. What it means is, if you have a spouse and your spouse is not working, okay, then she's your spouse dependent. So you are eligible to have additional 14,000 for federal and 10,000 for provincial. Okay, this is the reason why a lot of nannies who came here in Canada and their husbands are there in the Philippines, they get more refund because your husband are considered zero income. Okay, because the spousal credit, your husband doesn't have to be here, or your spouses doesn't have to be here. As long as you're married or in common law status, then you can claim spousal credit. Before, CRA used to be so lenient on this, but now CRA is getting strict. What CRA wants is, if you want to claim spousal credit and your spouse is not a resident of Canada, you have to show proof of support, and you have to show them that you're sending money regularly. They don't have a guidelines of how much you should be sending, as long as you're sending it regularly. So if you have that proof of support, then you can claim spousal credit. Next is amount for eligible dependents. So this is applicable for single parents. That's why most single parents also have more refund, because their children generates another basic credit, similar to your basic credit. Age amount. So these additional credits are given to seniors. Okay, so if you're 65 years old and older, so you get additional 7,000. So what it means, the first 21,000 income of the seniors are not taxed. Caregiver amount. So in case you have your spouse or children are considered infirmed or disabled, so you can also get additional caregiver amount for that. Disability amount, in case any of us will be considered disabled, occupational disabled, meaning we cannot work because of our disability. Even if we can work, but our sick, what do you mean by disabled? What I call that? Disabled as per CRA's definition. If any of our 6 basic functions are altered, like eating, feeding, walking, dressing, defecating, and bathing, if any of those functions are altered because you can't see, you cannot walk, you're diabetic, so you can be qualified for disability credit. Okay, so the only exception for CRA is diabetic. As long as you are insulin dependent, like you're taking your own insulin, the injectable insulin, then you already considered disabled as per CRA, because without your insulin, your body cannot function. Medical expenses. So for medical expenses, let's explore more about this. It has to be excess on 3% of your net income. So what do you mean by that? For example, for federal tax, for example, you have $2,000 of medical expense, and this client earned 30,000 income. So the eligible medical expense has to be more than or in excess of the $900. That's why 2,000 minus 900. So the non-refundable tax credit is 1,100. Okay, then 15% of that's your credit. So and if in case the income is really high, so it should be at least 2,400. Okay, more in excess of the 2,400. So for Ontario, it's same thing. Okay, it's in excess of 3% of the income, which is why for medical expenses, the lower income spouse should claim. Why? Because so that if this income is lower, then the deductibles is also lower, then you can claim more medical expenses. Okay, so if your accountant are not telling you that the spouse should claim, for example, the wife's a lower income, the wife should claim all the medical expenses of the husband, the wife, and the kids. Okay, including grandmother. What else? Student loans. Okay, interest, only the interest, not your monthly payments. Okay, so you can download that from OSAP. They will not mail it to you. You have to log into your student loan account and then print that and show it to your accountants. Tuition credit. Okay, tuition credit is only when it is needed. Okay, the software will calculate based on your income, based on your tax deductions, how much tax you need to pay. Okay, if you don't pay if you don't pay any tax at all because you have more credits, then your tuition credit may not be useful. But it's not gonna go to waste because it will be credited to the next year. Okay, so only provides credit to federal tax. Unfortunately, Ontario doesn't give credits anymore to tuition credits, because as per our premier Doug Ford, he said he's adding more money now to the grants, okay, to the student grants. So that's why he's not giving more money to our taxes. So software will calculate how much is needed for the tax payable, and any unused credits may be transferred to a spouse. Maximum of 5,000. For example, for any international students here and your tuition is 16,000 and above and you don't work, so basically 5,000 of that can be transferred to your spouse. So the tax credit for federal is 15%. So that's additional $750 refund. Okay. And then you can also transfer it to a parents or grandparents, or you can carry it forward to the following years. So that's why most of my college students, sometimes they want, especially if they have OSAP. So I told them, well, you can ask your mom to claim for it for the 5,000, and then just get the 750 from your dad or from your mom, or I can carry it forward when you started working 2 or 3 years after. Either ways will work. So that's why if you have clients or who know someone who are college students and no income, they have to file their tax. Otherwise, the tuition credit will just be wasted. Okay.
Clive, sorry to interrupt.
Yes.
Since you are the host, can you please admit those who are in the waiting room?
Oh, okay. That's why they keep showing. I didn't realize.
Yes. I cannot admit them because you're the host now.
Okay.
Thank you.
Okay, let me just admit them first. Okay. What else? Home buyer credits. Okay. So this is when you buy for your first home, you get 5,000 federal credits only, no provincial. Okay. So 5,000 credits is equivalent to $750 refund. If you have a refund. Okay. So only 5,000 per home. For example, if there are 4 people sharing the house, so it has to be 250, 1,250 each. Okay. So it doesn't matter though if you split into 4, split into 2, it will be the same amount of refund anyways. It doesn't matter if your income is high or big. So it's equivalent, the 5,000 is equivalent to $750 refund. So again, for non-refundable tax credits, CRA will calculate all these applicable credits you have, and for federal, they will multiply that by 15%, and they will deduct that from your income tax, okay, from your federal tax. So for provincial, it's 5%. So how about donation? Okay, let's talk about donation. Donation actually has very big impact when it comes to our taxes. So donation is, if you donate less 200 or less, 15%, it's direct deduction to your tax. Okay. So that will not be $30 times 15%, not anymore. The $30 will be deducted from your federal tax. And then if you anything above 200 is 29%. So for example, in this particular client, if he donated $2,000, 552 will be deducted from his tax. So, but if you don't work and you don't have federal tax, so this will just be wasted. So you can pay, and then for Ontario, the same thing. So 5% for first 200, and then 11% for the first 1,800. So the second 1,800. So in this example, the higher income spouse should claim for donation. Why? Because higher income spouse normally have higher federal tax and higher Ontario tax. And that's why for if you notice the rich and the wealthy, they donate a lot of money. Because instead of, in this example, imagine if this client only donated $2,000 and 700 was actually a return. So that's actually a very good number, right? So that's why rich and the wealthy, they donate more money and they promote their business and their donations. So it's actually hitting two birds in one stone. They're promoting their business, and at the same time they're doing good to the community. Okay. So now let's talk about RRSP. So a lot of misconceptions about RRSP. A lot of people, they buy RRSP blindly without realizing what they're going into. Okay. So RRSP, so let me, so a lot of people don't really have comprehension of what RRSP, what the FSA is. Sometimes some people will say, I'd rather go to the bank and open RRSP. And they said, well, I think RRSP in the insurance company is better. So it's actually the same. Okay, consider those as those like baskets. Okay, we call it investment vehicle. So we have different types of investment like savings account, GIC. In the Philippines we call it time deposit. Here we call it GIC. Bonds, mutual funds, segregated funds, and stocks. So any of those investments we can put in different baskets. So the baskets are the what CRA is treating them for the first one is non-registered. Now we have a tax-free savings account basket. We have an RSP basket, then employer pension, RSP, and RDSP for disabled. But we're just gonna talk on these first three because that's what's related really to our income tax. So non-registered, as the name itself, meaning it's an open account. Anybody can participate as long as you are in Canada when you open that account. Even tourists can do that, right? The advantage, anybody can participate, no restrictions. You can invest as much money as you can. The disadvantage, no tax shelter. So the growth and the gains will be taxable, and the income will reduce government benefits, like it can reduce your refund, GST, Canada child benefits, or even government pensions. So if you don't specify anything, if it's not RSP, if it's not TFSA, it is non-registered. Like our checking accounts are considered non-registered. So the tax-free savings account is the opposite. It's the name itself. The advantage is tax exempt on growth. Okay, income from withdrawals will not reduce government benefits. So any withdrawals is not considered taxable income. Though the disadvantage is very limited. So consider this as a small basket. The maximum you can contribute for this year is 6,500, but that's accumulative, meaning if you don't use your 6,500 this year, it will be carried forward till next year. So that's why I always tell my client, if you're not using your TFSA basket, you're wasting the tax exempt room. So if you have any savings in the bank, any GIC, make sure they are TFSA and not just as normal savings. Because if our investment or savings account earn $50, okay, the bank is now obligated to give you T5. So any T documents, that's your income. So again, our lowest tax bracket is 20%. So for example, you earn $60 on your investment. That's not much, right? But on that $60, you pay 20% tax on that at the end of the year, or it will reduce your refund by 20%. It's not worth it. That's why, as much as possible, saturate your tax-free savings account basket. And another mistake of many people, what they put in their TFSA are savings account, account that doesn't grow.
5,000 na lang sa una, 14,000 ganun.
Okay, please unmute everyone. Please mute yourselves. Thank you.
It's okay, I muted it. And now the RRSP basket. Let's talk about the RRSP basket. So RRSP is a tax planning tool. Okay, remember, since it is a tax planning tool, you should use that in relation to your tax planning and to your tax bracket. You should not buy RRSP blindly. Okay, why? Because though there are advantages on the RRSP, but sometimes the disadvantage way more than the advantages. So the growth is tax deferred. It's not tax exempt, it's tax deferred, meaning you're not gonna tax yet, but you will be taxed. It's not just not yet. Okay. And then you can contribute in behalf of your spouse. So the reason why we do that, because for example, if I'm the husband, I earn so much and my spouse doesn't, then when I retire, I have higher tax bracket because I have bigger pension while my wife don't have. So that's why CRA allows us to contribute in behalf of a lower income spouse. So when we both grow old and retire, my spouse will withdraw from her RSP, she will be taxed, but her tax bracket will be lower. But while contributing to the RSP on a spousal contribution, the higher income spouse will be
credited for the for tax calculations. I will be the one taking advantage on the tax break, while my wife will pay in the tax later on. But it's okay, when we retire, she will have low income, I'll have higher income. So that's basically how the essence why we can contribute on the spousal RSP. So again, depending on your situation, if you are both actively participating in RSP, if you think that the income gap between husband and wife is too much, then the higher income spouse should be contributing to the RSP, not the lower income spouse. And you can use this as a eligible for home buyer and first time home buyer. So this is what most people made mistakes. Okay, I'm gonna contribute because I'm gonna use it as a down payment on a house. Okay, let's explore that area later on. Disadvantage: only limited room. Even if you have a lot of money, but if you can only contribute 18% of last year's income, maximum 26,500. So if you did not work last year, you don't have any room this year. And any amount you contributed in excess of your allowable room, you pay 1% penalty per month. Okay, so for example, I contributed 5,000 extra because I did not realize that I exceeded my limit. So I have to pay $50 per month on that 5,000 excess. So it's not worth, because not unless your money is growing more than 12% per year. And withdrawals are subject to withholding taxes. So the moment you withdraw, the banks or whoever is the provider of the RSP has to withhold tax. 10% if it's up to 5,000. For example, if you withdraw 1,000, the bank will take $100 right away, and you will only take home 900. And then anything above 5,000, 20%, and any above 15,000 is 30%. So what it means is this withholding tax is it will not go to waste, right? At the end of the year, if you don't really pay tax because your income is really low, then it will be refunded to you. So the essence here is for seniors who are retiring and their income is really low, that even if they withdraw from their RSP and there will be a tax withholding tax, they might get those as a refund. So income from withdrawals are considered taxable income, so it will also reduce all other government benefits like GST, Trillium, and child benefits. So let's put this into example. So everyone's very familiar with this. This is our T4, right? So on box 14 of your T4, that's the income. That's how much you earn from that particular employer. And then the box 22, that's how much they took from your payroll as payment to your income tax. So when you file your tax at the end of the year, it will be calculated like this. So for example, your income is 48,000 and your employer deducted 7,200. And then when I do your tax, as per tax bracket and with all your deductions, you're supposed to pay 7,200. So this is what I call break even. Right? Some of my clients are telling me it's okay for me, Clive, not to get a refund as long as I don't pay. Actually, you already paid in advance. So, but if your employer deducted only 5,000, then you had to pay more tax, right? More, or you have tax owing of addition of another $2,000. So this is the impact of RSP, the benefit of RSP. For example, you earn 48,000, and then an insurance advisor told you, like, just do RSP loan of $10,000. It will give you 44,000 refund. That's what they normally say. You can get up to 4,000 refund. So let's test that theory if that's actually true. So now your taxable income became 38,000 because the 10,000 minus will be deducted from your taxable income. So your taxable net this time is 38. Actually, that's supposed to be taxable net, not taxable gross. So the tax for the 38,000 is only 4,900. So you get a refund of 22,300. So that's why, depending on the tax bracket, is what RSP is beneficial to a certain taxpayer. So in this example, it's only 23% tax benefit. Not bad, actually, because no investment is going to guarantee you with a 23% return in the first year. Only RSP can do that. But again, I always tell my client, RSP is like a bait. Once you put money on that RSP basket, if you take it out, that's income, right? Because whatever you put in there, it will be deducted from your income. If you take out from there, it will be added to your income as well. So then at the same time, the RSP benefit, since your taxable income, a taxable net income has lowered, it will also increase all government benefits. So now let's see, what if the client decides to withdraw? Okay, so more than 60 or 70% of the RSP contributors, they will attempt to withdraw their RSP contribution before they retire. Okay, so the idea for RSP is, if I go back here, so now you earn 48,000. The idea here though, even if you withdraw later on, it will be taxed. Your income will no longer be 48,000 when you retire. So your tax bracket will be lower. So that's the idea for RSP. But if you withdraw it while you are still fully working, for example, you take out 10,000 because you went to the Philippines and nobody advised you that it's actually a bad idea to withdraw from RSP. Now your income becomes 58,000. That made you go to the next bracket. Okay. Actually, it's a mistake. Sorry. That's supposed to be, sorry. I think I made a mistake here. Okay. So that's supposed to be the tax for the 58,000, not that, but that will be 10,000 something. So that's why you're supposed to pay additional tax owing. Let me just fix that. Okay, and then this should be 10,000 ish. Okay. Yeah, so in this example, the client will now pay more tax because now the client is no longer in a 20% tax bracket. The client is now on a 29% tax bracket. So that's a 29% tax clawback. And it will also, it normally decrease all other government benefits. So if you noticed here, most of the times, RSP will penalize more tax to the client than the refund that they took advantage in the beginning. And that's not the only thing with RSP. RSP as well, although it is taxable upon withdrawal, CRA has an exemption. We call that tax shield withdrawal, okay, for home buyer plan. So if you use your RSP as a home buyer, CRA will not tax you yet. They will tax you, but not yet. Okay. The maximum that you can withdraw from your RSP as a down payment to your home is 35,000. Providing that you should not own a house in the last 5 years. Okay, before we call it first-time home buyer. This is only for first time. Now, even if you own a home before, but you sold it and then you rented for the last 5 years, then you can re-enroll to home buyer plan when it comes to RSP withdrawal. So, but if you choose to do that, CRA will amortize your withdrawal in the next 15 years. 2 years after you bought a house. Okay, let's put that into example. What if you withdraw entire 35,000? And then, for example, you withdraw it now, 2023. By 2025, you have to contribute 2,300 per year. Otherwise, this 2,300 will be added to your income. So the impact on your tax will be like this. The RSP repayment is 2,300. So now your taxable income becomes 50,000. Okay, so the tax for the 50,000 is 800. So now you have to pay additional tax of $800. So this is what the most common mistakes of people. If they want to contribute to the RSP as a down payment to the house, don't do it monthly. Because me, if I put money monthly, for example, I'm putting $200 per month. At the end of the year, I only contributed 2,400. And I am still on a 20% tax bracket. My income is really low. So my benefit on that 24,000 is how much? Like 2,400, I mean, is only like $400-ish. The question though, what did I do with the refund? No, most people, they just spend the refund. If you spend the refund, that's gone. And then later on, when you withdraw that, it will be added to your income later on and you'll be taxed. So if you're putting down payment for your house, don't put it to your RSP yet, put it to TFSA. And the year before you buy a house, that's when you put your entire 35,000 in RSP. And normally when we buy a house, our income will be higher in order for us to qualify for a mortgage. Then our tax refund for that will be based on a 30%-ish tax bracket, not when your tax bracket is lower. In that way, for example, if I am on a 37% tax bracket, I put 35,000 RSP lump sum, my refund will be 12,000. That 12,000 refund that I got, I can use that in renovating my kitchen, buying appliances. So later on, even if I'm gonna be taxed $800 per year, it's okay because CRA allowed me to borrow 12,000 with no interest anyways. Right? So that's what RSP home buyer credit should be used. So if I am in this situation, that's actually better because if there's no tax shield withdrawal in your RSP, it would look like this. For example, if you have, without tax shelter, if you have 48,000 income and you withdraw 35,000 from your RSP, meaning you take it out not because you buy a house, then your income becomes 83,000, and you have to pay tax 10,000 more, right? So that's why a home buyer is good approach because CRA lets you borrow money in a form of a refund without interest, but you have to pay tax later on. But the question though, if you are on a home buyer, what if you are now repaying your RSP? Is it really worth putting back there? No, CRA really allowed you to take it out lump sum, but tax you gradually. Is it really worth for you to put it back? Okay. Again, I always tell my client with RSP, either you pay tax now or you pay tax later. Okay. So now let me show you the relationship between government pensions and RSP. So that's why I am allowed to sell RSP because I'm an insurance advisor, but I don't offer it to everyone. Okay. Because we have 3 types of pensions in Canada. Okay. Our first pension is Canada Pension Plan. So that's the maximum we have for now for CPP is 1,253. Even if you're a doctor, a nurse, a lawyer, even if you're a millionaire, when you retire, you will only get 1,200 maximum. Wow. Right? No joke. That's not really that big. But average Canadians are only getting $700. Okay, that's the first pension. In the Philippines, we call it SSS or GSIS. I think that's part of our monthly income that we contribute to our own government pension. The second pension that we have is old age pension. So it's 685 if you're 65 years old, and above 75 years old, would be 754 as of 2022. So every year they increase because of inflation. But this is income sensitive. The moment you reach 75,000, that will gradually reduce until if you reach more than 129,000 income, you will no longer have old age. Okay, so these are not for very wealthy, but middle class Canadians and seniors will still get old age. So old age is you have to live in Canada for 40 years in order for you to have old age pension. And if you live less than 40 years, it will be prorated. For example, I came here on my 40s. When I retire, I only lived in Canada for 20 years, half of the 600. So do your math. Your CPP is 700, and then your old age is 300 only. You only have 1,000 pension. Is that enough for you to retire? So don't worry because we still have another pension. The last one is supplement. Okay. Supplement is additional money given to CR by our government, by Canada, so that our pension will be at least 1,700 to 1,900. But the problem with supplement or GIS, it is very sensitive to income. Okay, so the maximum we get for supplement is 1,000 if you're single, providing that your income is less than 20,000. So if you're gonna be single forever, you're not gonna marry, and then you have lesser CPP, you have lesser old age because you didn't work much, you might get the maximum supplement. But if you're married, it's only $600. Okay, providing your income is not more than 27,000. But again, supplement is very sensitive to income. Okay, so if you add any income on top of your CPP and old age, half of that income will be deducted from your supplement. So let's put that into numbers. So now, what if Jane Doe is having RSP and she's now withdrawing 1,000 monthly from her RSP? Okay, so supposedly this in the first year, for example, this is her government pension. If she starts withdrawing 1,000 from RRSP and and providing the tax bracket is 20%, so only 800 that she can utilize. So in the first year, it may look good. Okay, I have 2,700. But on the next year, that 1,000 per year, half of that will be deducted from the supplement, so she no longer have a supplement. So she will end up having lesser pension. So if we do our math here, the withdrawal of the 1,000 actually will cost the taxpayer 20% tax plus reduction in GIS. So it's actually a 70% clawback. Is that worth it? So that's why I came from another insurance company and I always argue with them, why you're selling RSP to nannies? Why are you selling RSP to people, single parents whose income is less than 30,000 or 40,000? Because they might be depending on their supplement later on. So you're actually hurting your clients instead of helping them. Yeah, refund is like a bait, okay, refund. The moment you took a bite on it, it's gonna be on your bum forever. You're not gonna take, you can't get away from the tax. The thing with RSP though, the most disastrous with RSP is dying. Because for me, I always tell my client, the greatest risk of investing is not the market. The market will go up, the market will go down, but it will always pick up. The greatest risk of investing is dying. If we die, that's it. That's the end of the line. The problem with RSP, if we die, RSP is our income. It's funny though, when we die, we still have to file our own tax. We call it final tax. It's the same income tax that you do, but we just have to put date of disease there, meaning the client or the taxpayer already died. So when we die, our RRSP will be converted as an income to the disease. So I have a client who died with COVID, 62 years old. Imagine that. And he has, I think he has over 130,000 in RSP. And he was a chemist. He had 85,000 income because he died in October. He didn't die in January. So he still has employment income from January to October, plus the RSP income of 130,000. His income became 200,000. So imagine that. The income for 200,000, the tax of that is 43%. Half of that RSP just went to CRA. So that's why, is it really worth putting money to RSP? Me, I don't have RSP. There are so many vehicles for your retirement, but not RSP. So who should contribute to RSP? Taxpayer with higher income and higher tax bracket. Okay, if we, for example, nurses. Why? Because nurses, their income is 100,000 or more. It makes sense. They would get a refund of 37% out from their contribution. So for example, if I'm a nurse, I put $10,000, I would get 3,700 refund. That's a very good number. No investment's gonna guarantee me with 37%, only RSP. Providing that I will reinvest that 3,000. If you contribute to RSP, regardless of your tax bracket, and you don't intend to reinvest that, you just intend to spend that, it's not worth. Why? Because you're gonna pay more tax later on. The nurses, anyways, when they retire, they have good hospital pension. So they may not get any GIS anyways. So it's better to have RSP because when they contributed, their tax bracket is at 37%. And then when they retire, their pension will be less than 40,000 anyways. So they will be back to 20% or 24% tax bracket. Although they pay 20% on that RSP withdrawal, but that 3,700 that they saved years ago probably is now like $20,000 or $30,000. So they have money to pay for their tax. So again, RSP is a tax planning strategy. It is not a free-for-all plan because it will hurt you more than the benefits. And then another problem that I've seen with some of my senior clients, they try to restrict withdrawing from their RSP, thinking that they don't want their supplement to go very low. So instead of them withdrawing 1,000, they withdraw 400, 300. So they still have, for example, 80,000 in their RSP or 50,000 in the RSP, and then they died. So that 50,000, half of that will probably go to CRA. See, so there's no win-win with RSP. The only exception for RSP upon dying, if you made your spouse as the beneficiary. Okay, if you have RSP out there, name your spouses as the beneficiary, not your kids. Because, for example, if I have RSP and then I die, all my RSP will be given to my wife. So the banks or the insurance company will issue a check to my wife. For example, I have 100,000. They will give it to my wife, entire 100,000. But at the end of the year, by February, my wife will get the T4 RSP of 100,000. So she will be taxed with the 100,000. But if she has 100,000 RSP room, the 100,000 that she got from my death benefit, she would put it into her RSP contribution. So she will now have an RSP contribution of 100,000 plus a T4 RSP of 100,000 income. So that will offset each other. And then later on, she will just withdraw probably 15,000, 10,000 per year. At least the gradual withdrawal will not increase her to the next bracket. But if you name your children as the beneficiary, it will be your income first before it will be passed to your children. Okay, so never name anybody as the beneficiary, only your spouses. If you're single, don't contribute in your RSP. It's not worth the risk. Okay, so for example, okay, now we go on the tax strategy. Okay, so if you're an employee earning 65,000, okay, based on my experience, I've been an employee, I've been a self-employed, I've been both, like investor. This is the best way for you to manage your taxes. So in this example, the client is earning 65,000, but 12,000 was taken out from the paycheck, right? So if that's the case, imagine that minus CPPEI, the net is only 49,000. That's why when I do their taxes, many of my clients are complaining, what, I earned that much? I don't feel like earning that much. Actually, you didn't earn it. You pay most of that back to the government, right? And the moment you spend that 49,000, we pay HST in Ontario of 13%. So we lose additional 13% out of the 49,000. So tax should not be taken lightly. That's why retirement planning and tax planning should go hand in hand, because the last thing you want when you retire is to get more tax. So going back to the RSP topic, if your intention for buying RSP is just to get refund, and then you spend that refund later on, it's not really worth, because the government is just teaching you to be extravagant spender. And then because the moment, example, I get 2,000 refund from my RSP contribution, and then I would spend that, I lose 13% right away from that because I pay HST. And then later on, when I withdraw, if I withdraw before I retire, I get more tax because I will be in a higher tax bracket. If I withdraw when I retire, I will still be taxed and I will lose my pension, portion of my pension, right? So somehow, in the case-to-case basis, it has to be taken into proper consideration. So in this example, if the client is earning 65,000, the net is only less than 50. Okay. So, but if the client, so instead of this client earning $30 per hour, it's actually $23 per hour. Okay. So, but if you're self-employed, that's why I always tell my client, many of my clients are being asking, Clive, how can I save taxes? Be self-employed. Because my tax, or how I plan my tax profile is it's actually years of planning, right? When I first learned about the Canadian taxation, I realized right away that being self-employed is actually the easiest for me to win from my taxes. For example, this 65,000 is a commission income, or for example, for a business income. For a business income, you can claim expenses, right? Even your personal expenses can be part of a business expense. For example, the expense is 30,000, the taxable income will now be 35. So it will be in a lower tax bracket. The tax for that is only 4,000. Although you pay more CPP as a self-employed, but the total deduction at the end of the year is only 7,000 compared to 15,000 as an employee. So as a self-employed, you're actually able to deduct 8,000, save 8,000 from your taxes. Okay. So, and it will also increase your GST, your Trillium, and your Canada Child benefits simply because you are self-employed. So imagine, as a self-employed, these are the expenses that we can claim. If you notice, many of those, we are actually using them. For example, the most common is meals and entertainment. We already eat outside in a ways, right? Why not use that part of our business, especially the motor vehicle expenses. We're driving, right? If you can use that as part of your expense deduction to your income, that will be better. So if there's a way for you to transition from employee to self-employed, you can do both. Like for the longest time, I was a accounting supervisor, and on that side, I was doing income tax and I was doing insurance. And the reason why I went, okay, this is not a recruiting. Okay, I'm just gonna just show you possibilities. The reason why I went to the insurance industry in the beginning was not because I wanted to sell insurance. No, I hated selling insurance in the beginning, because if you sell life insurance, the other side of that is telling people that they're gonna die. I don't like the idea of dying. But the insurance business is the only type of business that I don't have to spend too much money in maintaining my business. And at the same time, I can maximize all my expenses. Because with tax business, though, yeah, I can claim almost everything with my tax business, but I cannot justify why I had a trip in Niagara. I had a hotel accommodation in, for example, in Quebec, or on after tax season. But if you're an insurance advisor, you can go anywhere, everywhere under the sun, for the purpose of prospecting some clients. So that's basically it, right? So when it comes to taxes, it's the way you manage it is, first, make sure that you pay the rightful taxes in the beginning if you're an employee. So again, check your pay stub. Pay stub is important. Be sensitive to your tax brackets. You can always check CRA website anyways, or you can ask your accountants. I'll be willing to share every year's tax bracket to my clients, because it's changing every year. And then second is maximize all your credits. Okay. And then for me, it's better to pay tax in advance and pay tax later. Okay. In that way, you can manage your income properly, like that, the spendable income. So I rather pay the rightful tax. So other credits that we have is, now we have one-time top-up housing, Canada housing benefit. So it's $500. So you only have until March 1 to apply for it. So you need to have your My CRA, and under there you can apply for that. Okay. So just try it. If you're not eligible anyways, it will tell you they're not allowed. But what if you're allowed? No one's gonna give you extra $500 in today's money. What else? We also have Canada dental benefit. If you have children and you don't have private insurance and you're not qualified for the Healthy Smile. Okay, so if you have anybody here who's earning, I think 30,000 or lesser, we have Healthy Smiles anyways. The Healthy Smiles, it's a government benefit. So it will pay for your children's dental. Okay. So for that, it's $260 per child. Okay. Or $650. Okay. Tax repayment $260, $390, or $650, depending. So just apply, right? What else? We also have Ontario Staycation Tax Credit. Okay, everyone's actually excited on it, because a lot of people spend their money last year hoping to get this. So it's not that much though. It's like $1,000 per individual, or $2,000 for a family. So that's equivalent to $200 refund. This is refundable tax credit. Okay, meaning if you have zero tax, you still get $200, or $400 for a family. So again, if you have more questions, you feel free to get my number. You can send me email. I'll be glad to reply to that. And at the same time, this is recorded, so I will post it on our website. So our website, let me just share you quickly where our website is. Okay.
Thank you for taking time to watch my video. I hope you learned a lot from it. I also encourage you to watch more of my videos. Please visit my website. It's www.taxcall.ca, and on our website, please click on Tax Tips, and in there are a series of practical videos about personal taxation, investments, insurance, and other financial matters that you might find beneficial. Please find time to watch them and learn from them. It is my takeaway to you guys as one of my most valuable clients. Thank you very much and have a great day.